I think the stock market is in a better position today than earlier this year when it made its all-time high.
Tom Lee's central claim is bold. The U.S. stock market today is healthier than it was at its previous peak. Why? Because markets have now been tested and passed. He points to three key developments. One, resilience to oil shocks. Historically, spikes in oil prices have been deeply disruptive, often triggering inflation surges and economic slowdowns. But this time, the U.S. economy has demonstrated an unexpected ability to absorb higher energy costs without collapsing. While other countries face factory shutdowns and economic strain, the U.S. continues to function relatively smoothly. This divergence reinforces the idea that the U.S. is, in Lee's words, the best house in a tough neighborhood. 2. Earnings growth remains intact. Despite geopolitical instability, corporate earnings have continued to rise. This is critical because earnings ultimately drive stock valuations. If companies are still growing profits, then the foundation of the market remains solid, even if headlines suggest otherwise. 3. Inflation fears may be overstated. Lee revisits historical data on oil spikes and finds that their impact on core inflation is often less severe than investors assume. That means the feared inflation shock, one that could force aggressive central bank tightening, may not materialize to the extent many expect. Together, these factors suggest that the market has already digested a major stress test and emerged more stable.
Let's ask our headliner today, Tom Lee. He's Fundstrat's head of research, chief investment officer, also a CNBC contributor, and it's good to have you back. Welcome.
Great to see you, Scott.
Told us that you thought the bottom was in and that new highs were in reach. Now here we are. Now what?
I know this is going to sound counter to what the viewers might think, but I think the stock market is in a better position today than earlier this year when it made its all-time high. Because one, we're now seeing that the U.S. stock market can handle a surge in oil while it hurts other countries. We've seen earnings go up, so we now feel comfortable that the war is actually stimulating the economy. And the third is, I know I've talked before about inflation shocks, but we've been looking back at the history of oil spikes, and the impact on core is less than we thought. So I think there may be less of an inflation shock coming. So I think stocks can go back to that 7,300, which is our base case for this year in our three-phase market, before we might see a larger drawdown.
Well, I hear you essentially saying that the U.S., in some respects, as a result of this war, is the best house in a now more uncertain neighborhood.
That's right. This is the seventh black swan now thrown on investors since 2020. And now we've seen that the U.S. can handle a Middle East catastrophe, one where the strait is closed and oil's not available. The U.S. economy is still operating while other countries are talking about shutdowns and factories closing.
You don't feel in any way, or you're not concerned that you may be complacent to the risks that are still out there because of the war?
There are tail risks. I think that the size of the tail has shrunk, tail meaning a downside risk. And I do think that there's a lot of folks who are credibly pointing out that the shock could still hit the shore in the U.S. because of things like helium and other commodities. So we are watching that, Scott, but I'd also say that we could have a positive tail risk, which is if we can find a lasting ceasefire, then whatever shock hits the shores is so short in effect that it won't hurt our base case.
The NASDAQ is trying for its 11th straight positive day. It'd be the longest streak since November of 2021. There are those who believe, like JP Morgan does, that if the next leg of the rally is going to be strong, tech is going to have to lead. Do you agree with that call?
Yeah, we do. I think that it's still useful for people to look at what has outperformed since the war started. And, number one has been Ethereum and Bitcoin, which are crypto, but they're highly correlated to tech. Of course, there's energy stocks, but then it's led by tech, and the Mag 7, and even the software. So I think that JP Morgan's correct. I think tech is growth when people are worried about growth. And of course, it's also been the most under-owned group because that's the group people were selling.
Well, part of the call is that you're going to get the best earnings growth from tech. There are more notes about that today, while at the same time valuations have fallen. So these stocks in some people's eyes aren't as pricey as they used to be and look even more attractive because earnings growth estimates are solid, if not increasing.
I mean, that sounds right, Scott. These companies have true moats. They've grown earnings consistently faster than the S&P. I think they're going to be one of the winners around AI. And you're right, to buy them at a market multiple means that 5 years from now, I think people are going to be surprised that they could buy them so cheaply.
Lee describes the current environment as one shaped by repeated black swan events, rare, unpredictable shocks that disrupt markets. Since 2020, investors have faced multiple such events, from pandemics to wars to financial instability. Rather than breaking the system, these shocks have forced adaptation. The latest geopolitical conflict, including risks around oil supply disruptions in critical regions like the Strait of Hormuz, represents yet another test. The fact that markets and the U.S. economy are still functioning suggests a level of resilience that investors may be underestimating. However, Lee does not dismiss risks entirely. He acknowledges tail risks, low probability but high impact events, such as supply chain disruptions involving critical commodities. But he also introduces an important counterpoint: positive tail risks. For example, a sudden ceasefire or geopolitical resolution could quickly remove uncertainty and fuel a sharp market rally. In other words, risk is not one-directional.
So Luke charted Bitcoin over tech, and Bitcoin's been resilient, man. It really has. And again, it usually leads. And so is it smelling something? Is it something that we don't know? Free markets are the ultimate truth tellers. Bitcoin will figure it out before you will. Before the headline comes out, the market will figure it out. It's the most free and fair market we all have access to. It's the only free market left. So is Bitcoin sniffing something out? Is it sniffing out a Trump taco? Is it sniffing out a Trump uncle? Is it sniffing out the strait opening up to whatever, a lot of the East, which eases the pressure on oil? I don't know what it's sniffing out. Is it sniffing out that, Trump's new deadline, the market's expecting a deal, and tomorrow it's going to puke itself down because there's going to be no deal, and Trump is going to be embarrassed and have to come up with something else? I don't know, but it's been resilient. And I repeat my message. Now's the time to stay humble and stack sats. Turn on your DCAs. What are you to expect with a conflict like this, potential global economic crisis, oil prices through the roof? What's the expectation? What should you be on the lookout for? Guys, be wary that the Bitcoin price could nuke and puke at any moment. The global economy is extremely fragile. Everything is extremely fragile. You're seeing gold, U.S. Treasuries experience risk volatility like it's Bitcoin, like it's Tesla. I beg you to earn more than you consume right now. Now is the time to tighten the belt. Make sure you're bringing in more cash than you're spending. Review all the debt you have outstanding. Make sure it's productive. Okay? Potential for some uneasy times, but this is where legends are made. This is where people buy low. And mind you, turn on the DCAs. Do not wait you're not going to time the dip. You're not going to be awake and online with a cash account loaded to buy Bitcoin at the pristine moment that someone flies an airplane in the sky that says, hey, this is the bottom. Log into Strike and click buy. That's not going to happen. A year from now, 2 years from now, 5 years from now, you're going to say, wow, I had a chance to buy Bitcoin with a 6 in front of it. I can't believe I didn't act with more urgency. I can't believe I was waiting for a 5 or a 4 or a 3. What an idiot. So be responsible. Be productive. Turn on the DCAs. This crisis can't last very long. This Middle East conflict, oil shenanigans, we're way too indebted for this to go on for years without any new policy changes or Fed interference. There's just no way. There's no way. Mathematically impossible.
One of the more intriguing elements of the discussion is the role of Bitcoin as a leading indicator. Bitcoin has the most free and fair market available, one that reacts quickly to information and sentiment. Unlike traditional markets, which can be influenced by regulation, structure, or delayed reactions, Bitcoin trades continuously and globally. Bitcoin has shown notable resilience during recent turmoil, leading some to speculate that it may be sniffing out future developments, whether that's easing geopolitical tensions, policy shifts, or economic stabilization. The key idea here is not that Bitcoin predicts the future with certainty, but that it often moves ahead of traditional assets, reflecting collective market expectations in real time.